I will share in for our PowerPoint presentation. Okay, so yeah, welcome. For those who couldn't make it, hopefully you did not find assignment 1 very tough for you, but it is one of our easiest assignments. It's just the introduction to bookkeeping and just a little bit of testing in terms of a legal bookkeeping concept, of which if you manage to go through the manual or our study guide, I think you should have been able to answer. And I know you guys have done a lot of bookkeeping at high school level as well as at university level. So yeah, I hope you were able to cover. So welcome back. Our course is called Accounts Management course. It is basically the same as legal bookkeeping. And this is our second webinar. And our third webinar as well is going to touch on the same. We are going to just we continue with this same presentation, because what I've realized is that our assignment 2 is the one that is a little bit heavier when it comes to answering it. So I would want to spend more time on assignment 2, and then assignment 3 is not that difficult because we are not going to load a lot of concept, like even VAT. We have more of like removed it there so that at least when you are attempting it, you are able to recover from assignment 2. Okay. My name is Faustina Caserera. I'm a CASA. I am a registered auditor as well. So I am your facilitator on this course, as well as the one who is helping you with presenting the webinars. Okay. And then for our house rules, please make sure that your mics are muted so that we minimize the noise. So please unmute if ever you want to say something, because unfortunately when I'm sharing something, I won't be able to see who has raised his hand, because I more of like navigate out of the system, out of Teams, and then it is sharing from another platform, which is the document that is being shared. So I do not see if ever you raise your hands or you want to say something. So you just interject and say it, and then after we discuss, then you can go ahead and unmute. Okay. Thank you very much. I think currently we have one person who is not muted. Please, can you mute so that we minimize the noise? Okay, I've introduced myself. And from the previous webinar, I've informed you that if you have any questions, if you've got anything that you want to be answered in the periods that we are not in contact, so we only get in contact when we are doing our webinars, and then the other times we can only communicate through the forum. So the forum is there. I've shown you where you get to the forum on the platform. So for those who are not around and they want to see again, I can always show you at the end of the webinar. Okay. And then for any admin matters, admin issues where you are having challenges with submitting your assignment, you are having personal issues, you want your assignment to be submitted a little bit later, you can email Grace Mukuru. I think all of you do have her contact details, since she's our course administrator at the Law Society of South Africa. So please feel free, communicate with her, and then she will give me instructions to attend to any other issues that you would want. Okay. And then let's move on. We are now attending to we are now on our webinar 2, and the topics that we are going to cover, I hope this is clear for you. We are going to look at trust investments, and we're going to look at correspondent transactions, and then conveyancing transactions, VAT, and other taxes. So these are the areas that I'm just going to give you more detail to discuss further. The other topics that I have left out, we cover them because those are like the ones that we use for our practical examples, like the cash books and the ledgers. So whatever that we want to illustrate will always boil down to our cash book and ledgers. So when we are doing them, that's where you also get more information on that. And then reconciliations, that one you have done, bank reconciliations, you have done it in our assignment 1. So most of you got it right. So, and also if you read, it's nothing much in our study guide. It's just to explain that it's an internal control tool for us to check accuracy and completeness of our records. That's why we do reconciliations. So what is crucial for us in the legal fraternity, our trust investments, our corresponding transactions, conveyancing, and then from there, like another industry, we do VAT and how we apply it in our scenario. Okay, so let's start with the trust investments. Okay, so with trust investments, they also are coming from our section 86. So section 86 is a section of our Legal Practice Act. So you should go through section 86. 86.1 is the one that stipulates that every legal practice is supposed to have a trust account. Every practice should have a trust account. And then section 2, that's when then it indicates that one is to open a trust account, a general trust account. So every legal practice is supposed to keep a trust account, whether it's in use or not in use. A trust account is to be kept. So a trust account is not considered as a investment account, but currently, if you look at it, a trust account also earns interest. Why? Because the fund has gone out there and they've negotiated with the banks, they've gone to the banks and they've negotiated so that the trust account can earn interest because there is money which is just sitting in the trust account. That is for those firms who are keeping money in the trust account without having any instructions from the clients. So with such money, the industry, the fund has realized that if interest is earned, then that interest can be used to cover any liabilities that any legal practice can have, like for misappropriation of funds, whether by directors, by employees. Yeah, the fund can then turn, it's a fund of last resort. So as a last resort where the firm cannot pay, or the practitioner or the practice cannot pay its client, then you find the fund can then look at paying. So they are also just trying to protect the clients. They are trying to protect so that they do not suffer from the industry and blame the legal industry for any mishaps. You know, these things happen. Okay, so we've got our trust account, and then from there we've got section 86.3. Section 86.3, if you look at it, we are told that a practice can open an account, preferably a call account. You see, so this is an interest-bearing account which a practice can open, and then at the discretion of the directors or the practice, they can transfer those funds which are not readily in use. So it's funds which are available, and the firm is not under any pressure. The practice is not under pressure to utilize the fund. Say the matter is pending or it's on hold. The matter is on hold, such that this money is just sitting in the trust account, and the practice is just doing other things and leaving this money in the trust account. So they can decide to transfer that money into a Section 863 account. It can be a call account as long as it is held at any bank which is which was opened according to the Banking Act. Then they can open that call account, and that account should have reference to Section 863. So the bank statements of that trust account, of that investment account, should stipulate that it's a Section 863. And once it stipulates that, then it means the Fidelity Fund, the attorney's Fidelity Fund, the legal practice Fidelity Fund can cover any problems that can be encountered when funds are held in such an account. Okay, so with this account, this investment account, all the interest, 100% of the interest, okay, net of bank charges, is paid over to the fund. So now with the current arrangements that are there, you would find you can arrange with the bank so that automatically they sweep over the interest to the fund, and then you do not have to have a lot of admin issues. Okay, so that is in Section 863. It's rare you would find, because the fund is already negotiated in a trust account. It's most practitioners are not utilizing this account. But the good thing about it is that if ever, like for avoiding fraud, it's not available. So you'd find if ever there's fraud in a trust account, your funds in a Section 863 are protected, because usually it's not a transactional account, and it is safe from any cyber attacks, any hoax, because there's no access. It is ring fenced by the bank until you recall of those funds. Okay, and then let's move on to Section 864. Section 864, it's an investment account. And with this investment account, you find the client is the one that gives instruction to the firm and say, okay, of our funds that we are paying over to you, may you invest on our behalf. Okay, so for example, if it's a conveyancing transaction, then a deposit is paid for the purchase of a property. Then the purchaser can instruct the firm to say, may you invest my money into a Section 84 account. So every transaction should have its own account. So these accounts are held separately so that the interest, you are able to account for the interest of that particular client according to what has been credited into that account. Okay, so the other thing that we look at in a Section 864 account is that the money is supposed to be paid in a trust account. So the initial transfer should be in a trust account, and then in a trust account, we are waiting for the underlying transaction to proceed. And then we receive an instruction from our client, a written instruction that we receive from the client. And then with that written instruction, then the practitioner is the one who goes to the bank or who approaches the bank, whether telephonically or through banking channels online, and then open an account which has got reference to 864, and it should have the name of the client. Okay, and then after opening the account, then they transfer money from the trust account into that specific account. And also this account should be held at a bank which has been accredited by the Banking Act. Okay, so the account, which means it cannot be a money market call, it cannot be a unit trust, it cannot be anything else. It has to be a Section 864. Most banks, they know about these accounts. And when these accounts are opened, usually the interest that is due to the fund, because the fund then is written in its I think it's in its rules that 5% of the interest that is earned in a section 86.4 is supposed to be paid over to the fund, and the 95% is payable to the client. So with the 5%, if you go to the bank and arrange and go on a sweeping system, the bank will automatically pay. The bank will automatically pay this money over to the fund. Okay, so that's a section 86.4. So what we'll do, normally when we do our example here, we then do cover a section 86.4 account together with a conveyancing transaction, so that I can show you how it works and how you can record its transactions. Okay, and then the other thing is we have what they call an investment practice. With an investment practice, this is according to Rule 55.1. If you go to the rules, okay, so with an investment practice, the firm gets mandated by the client. There's no underlying transaction per se. So where a client says to the firm, can you receive so much, 2 million for us? Can you invest this 2 million? And they specify whether in a money market account or invest it in shares or invest it, then we call that an investment practice. So for it to be a fully fledged investment practice, the LPC usually and the rules, they specify that a firm should have 10 or more transactions, or 10 or more transactions from various clients where it's carrying out this investment practice thing, then would say it is engaged in an investment practice. So if you look at an investment practice, it has got its own rules. So if you its own accounting rules. So if you can go through the act, if you can go through the rules, you'll be able to see what is required, which records are required to be kept, because you would find whenever there are inspections to be done, then the LPC or the fund might even ask to say, can we inspect to see you're adhering to the rules and the sections of the act? Okay. All right, so those are the three investments that we have, but with us, we more of like concentrate on the section 86.4. And I have also mentioned that the fund covers the trust account, it covers section 86.3, and it covers 86.4 for misappropriation. Okay, all right, and then what you can then do in our study guide, that is our chapter 9. Chapter 9, it will explain the trust investments, and then it will show you the difference between a section 86.4 investment and a Rule 55 investment. Okay, so Rule 55 is the one that I was explaining there, that it's also not covered by the fund. Okay, and also according to the Law Society of South Africa, a firm that wants to conduct itself as an investment practice, they should also inquire with the Financial Services Board, because we are more of like now investing on behalf of people. So you should also inquire with the Financial Services Board, and then see if there's need for the firm or the practice to be registered. Okay, so if you can go through our manual, it has got more on Rule 55, what is stipulated, what needs to be kept. Okay, and then interest I've explained. Section 86.2, which is our trust account, 100% of the interest net of bank charges. So there are certain bank charges that are not recoverable, but the ones that are recoverable, then you can deduct them, and then the difference is what is payable over to the fund. And also on bank charges, the banks charge VAT. Okay, so the bank charges that are recoverable are net of VAT, because the LPC and the fund and LSSA, they've agreed that the VAT is recoverable from SARS. So it is the duty of the practice to be registered as a VAT vendor for them to recover. Okay, and then Section 86.3, 100% also, just like a Section 86.2, is payable over to the fund. Section 86.4, 5% is payable to the fund. And remember, I have informed you that with the Section 86.4, it's an instruction from the client, and money should be paid in a trust account, and the practitioner is the one who has got sole mandate to manage the funds. You cannot share the mandate with the client. So the firm is the one that is in charge of the funds, because remember, there is an underlying transaction. So the firm is trusted with these funds to then, when the transaction has come to finality, then they can pay over the funds. Say if it's conveyancing, so it says if it's say from the road expense fund, nowadays the court orders are coming with what? Those instructions. Okay, and then the 5% is paid to the fund, net of any bank charges, which usually are rare. Okay, so recording, then we'll discuss how we record. And then our next topic is to do with correspondent transactions. Okay, I don't know if you've got any questions on trust investments. Any questions on trust investments, or I can proceed. Okay, thank you. No questions. Let's proceed on our corresponding transactions. Okay, this one, it's something that is done in a legal fraternity. So with correspondent, the term correspondent, it's when one does business with another regularly. So what we'll be having is that with the way that the legal industry is structured, it's structured such that if a firm is in another province or in another province or in another town, it cannot go to another town, a firm or a practice. It cannot go to another town and represent clients there. So if it's instructed by its clients, say here in Johannesburg, to collect funds or to represent in a litigation the client against someone who is in another jurisdiction, then they have to appoint a correspondent firm, a correspondent legal practitioner advocate, who then will carry on with the matter. And then after carrying on the matter, then they account to the firm so that the firm can account to the client. Okay, so there's a firm instructed by its client, and then it instructs a correspondent to deal with the matter, and then the correspondent has to account to the firm, and it's vice versa. It can be also the firm which is being instructed to conduct a matter, and then after conducting a matter, then it has to account. So the client, when you look at it, the client here becomes the correspondent. So if, say, our practice is the one that was instructed to carry out a matter, it's instructed by the correspondent firm. So that then becomes, in our records, that becomes our client. So when we are recording our ledgers, we record them in the name of the correspondent, because we cannot account to their client, because they also have to take out a portion of their fee out of what would have surrendered over to them. And then after taking out a portion of their fee, then they can account to the client and show what transpired. Okay, so it's more of like an agent relationship. If it was a normal business, then it's like an agent where you have, say, a manufacturer, you have an agent, and then you have a client, or you have a wholesaler at the end. And with that relationship, then there is accounting that needs to be done. So that's basically what happens. So there is a way that the transactions are recorded, given who you look at who is receiving the instructions, who is giving the instructions, and then that is what gives you the way that you account for the transactions. Okay, and also the other thing that you have to note is that there is an agreed upon 1/3 allowance. So on fees that are due on the firm, the legal industry, the LPC, the fund, they've more of like agreed that the firm that is giving the instruction will get 1/3 of the fee as an allowance. So the thing is that it is not the one which is doing the work, but it has brought in work, you see. So in it bringing in work, so the receiving firm or the receiving practice, when it gets this instruction and it says, for me to consult with the client or for me to open in a file, I charge so much. So in that so much that they are charging, they have to pass on 1/3 of that money, inclusive of VAT, to the firm that is giving the instructions. So it can be 1/3, but say for instance, the firms have agreed on a fee, like they can agree on 20%, on 25%, on 50%. Yeah, then that's an agreement. And then with that, then the fees are accounted in both firms and then eventually account to the client. Okay. So remember, I have said that there's a VAT implication. So when we do an example, then I'll be able to show you how the VAT is dealt with. Okay, and usually the transactions that for correspondence, we are having collection commission. So usually a firm is instructed to go and collect on behalf of the client, and then once they collect, they take what is also due to them, and then after that, then they account. Okay. So, and the other thing is that the way that the transactions are recorded is just different. So you have to look, understand the question, and then see, is the firm being instructed or is it the one instructing? And then you account in such a fashion. Because remember, the firm that is instructed is the one that receives the full money from the client, from the other person, from the defendant. They receive the full money, and the firm that is instructing will receive money less the fees that were charged by the firm with the instruction. So you need to account for the transactions differently because of that. Okay, so that's conveyancing. I don't know if you've got any questions on conveyancing. If you do not have questions, we can proceed, and then we discuss VAT. Any questions on conveyance, on correspondence transactions? And with correspondence, you would find it's very complex. The way that we account for them is complex, but because we are going to discuss this, you will realize it's something that is doable because we are doing it together in a webinar. Okay. And our next topic is VAT. It's VAT. Just pardon me. I want to go back to our, okay, yeah, yeah, this is what we are sharing. We are doing VAT. Let's see. I think I've omitted conveyancing. Let's start with conveyancing before we go to VAT. Okay. So conveyancing, this is I think it's a structured process, legal process. It's not done by everyone, but we've got certain legal practitioners who, or usually it's attorneys, who then go and sit and write exams and become conveyancers. So this type of a law, it's a branch where then they are to assist the public with the registration of properties. Okay, so it is usually used to register properties or to transfer properties from the purchaser to the seller. So attorneys or legal practitioners are then needed to help with that, because they're the ones who can then generate the relevant documents, who are able to go to the deeds office. As long as they are registered with the deeds office, they're able to go and also present their credentials, I think. And then from there, then they help with the process. Okay, so how the property registration process is conducted is that usually we have a seller. Someone wants to sell their property, then we call that one a seller. And with the seller, what they do is that they can sell privately. They can sell privately, or they can decide to sell through an estate agent. Okay, and then in that process, and these estate agents are now called property practitioners. Property practitioners. Okay, so what then they do is that, say for instance, the property is sold through a property practitioner, and the property practitioner drafts the purchase agreements, the offer to purchase, OTP, they call it OTP, offer to purchase, or the purchase agreement, seller or the seller agreement. They draft the seller agreement. So it means now they have what we call a purchaser. They've identified someone who is interested to buy the property, and then we call that one a purchaser, which becomes our second part to the transaction. What they do is that they approach, so usually the seller or the estate agent, they've got their own attorneys who are conveyancers. They approach their conveyancer, and then after approaching their conveyancer, they inform them about this offer to purchase and the terms and conditions that are there. And the conveyancer approaches the seller, then contacts the seller and inform to say, okay, we have received instruction. We heard that you are interested in a property. And once the seller says, yes, I am, you can proceed. What they do is that they draw transfer and bond documents. So most properties here in South Africa are either sold for cash. So it all depends on the seller's affordability, if he can afford to buy it outright cash, or he requires he requires financing, that is the assistance of the banks. So with financing, then it means in the process, one is to get a bond, a mortgage bond, or one is to get a loan. And then with that loan, then that is used to pay the seller. So the attorneys, the conveyancer, then would draft. And if there's a bond that is to be obtained, then the bank will introduce bond attorneys. They are also more of like conveyancers, but now they're acting on behalf of the bank. So they are ensuring that they register an agreement between the seller, between the purchaser and the bank. Okay, and then after doing their bond papers, they contact the conveyancer, and then they present what we call a guarantee. So with a guarantee, the bank and the bond attorneys are guaranteeing that upon registration of the property, then the bank will be able to release the funds within 48 hours. Within 24 to 48 hours, so that the seller can be paid to avoid any prejudice. to the seller. Okay, and then what then happens is that usually, hello, are you able to mute? There's someone. Okay, so yeah, let's proceed. So once a guarantee has been received, the conveyancer will also ask the purchaser if ever there's any deposit payable, because with some banks you find they can finance 100%, some banks can finance 20%, or if it's a cash transaction, then the conveyancer will ask the purchaser to deposit the money into their trust account. And also, if ever they are receiving the instruction to invest, then they do receive the instruction to invest. And then from there, you find the conveyancer will then arrange so that the purchaser can come and sign documents and also submit any FICA documents that can be required. Okay. And then from there, you find if the property that is being purchased, its value is more than a certain, I think it's 1.3 million for now, then the conveyancers would calculate and present a pro forma invoice or statement to the purchaser and indicate how much duty is payable, how much are their fees. And once they get that, they also deposit that into the conveyancer's account, trust account, so that the conveyancer can start with the work. And from the conveyancer side, they also, even if the property is below threshold, they also just obtain a transfer duty receipt from SARS. If it's above threshold, they then also pay the amount that is due to SARS. And also the conveyancer will arrange, they've got, I think, runners who go to the municipalities and obtain rates. Like every property is supposed to, like the seller is supposed to pay rates and taxes on a monthly basis. So while the transaction is being executed, then the conveyancer will ask the seller to pay for 3 months, 3 to 6 months, to clear, and also to clear any outstanding rates and taxes, to ensure that when the property is registered, the purchaser is not burdened by the seller's bills. Okay, and also it applies to levies. If it's a property in a complex, then there are levies which also have to be cleared. 3 months levies in advance, as well as past levies which were not yet paid, then they are cleared. Okay, and then from there, once the conveyancer is satisfied, they lodge the documents to the deeds office. And once they lodge the documents to the deeds office, then the registration takes place. Registration, it means the property is registered from the seller into the name of the purchaser. And if banks are involved, they are also endorsed against the bank to show that they are also an interested party, and the title deed is ceded to the bank until the bank is fully paid. Okay, and then the conveyancer will then receive money in the trust account upon registration from the bank, because the purchaser is supposed to pay way back. So they receive money from the bank, and after receiving the money, they account to the seller, they pay the seller, they account to the purchaser. If ever there's any interest, like that Section 86(4) interest that has been received, then it is paid over to the purchaser. So you should note that. Okay, so that's basically what transpires with the conveyancing matter. So with us, when we get an example, we'll get with those instructions. Our duty is to record the transactions as they occur from inception up to accounting and paying the purchaser. That is our duty as bookkeepers for each and every transaction that we get for a conveyancing matter. Okay. So that's conveyancing. I don't know if anyone has got a question there, or we proceed. because what we need to do is that we'll take a break. Once we finish the VAT, we'll take a 10 minutes break so that we can go and drink some water, walk, and come back after refreshing, and then we'll proceed with an example where we then do an example. Our example, we will not finish it today. We'll proceed with it next week when we do our second webinar, because we want everything covered in this topic as it touches on the two left assignments. Okay. So any questions on conveyancing? Advocates, do you understand? Because I know most of you have not done conveyancing, but I believe people buy properties and you come across this. Okay, so our last topic has to do with VAT. The other topics we will have to read from the manual. Okay, so VAT from our manual. It's chapter 12, VAT and other taxes. Okay, so VAT, it's an abbreviation for value-added tax. And value-added tax, it's according to the VAT Act. So there's an act which governs VAT, and it's administered by SARS. So it's a tax, value-added tax. It's a tax. So it applies to almost every business that is conducting to every entity that is conducting business here in the Republic or even outside of the Republic. There are certain entities that are required to register for VAT. Yeah, so we had a question in our assignment 1 to say, when do we register for VAT? And yeah, most of you got it right. So the VAT Act stipulates that where fees, so we're looking at fees only for a firm, or if it's a company that buys and sells goods, where the sales exceed 1 million in a given 12 months period. 12 months period. So it doesn't have to be you're looking at your year end. It can be you just take from say August up to the next July. When you compare, your system tells you that you have done more than 1 million. Then in fees, not in money received, because sometimes you can receive money which is not yours, or you can receive money on behalf of other people, then that is not your money. But in your fees, if you receive more than 1 million, then you have to register so that you adhere to the Act. Okay, and also the Act would stipulate more to say there should be continuous business. So usually with a legal practice, there is continuous business. So we expect to see business to be flowing. And wherever you feel or the practitioner feels that it was just a once-off 12 months period where they made more than 1 million and they're not going to be able to achieve more than 1 million, then they can deregister for VAT. They can go to the commissioner at SARS and then apply for deregistration. There are forms which are there called VAT 123E forms that are there that one can use to deregister. And another instance, okay, another instance where a firm or a practice can register for VAT is, say, for instance, you have a client that you continuously service or you have a long-term relationship, and that client then says to the firm, can you register for VAT voluntarily? Like you do not meet the 1 million threshold, but would want you to register for VAT. So there are clients like that. So the firm can then go to the commissioner and then prove. When I say go to the commissioner, it doesn't really mean going to the branch. It can be online. if a practice has got an online profile, they can go online and register for VAT, and then they have to complete, there's a form as part of the online system. You go to maintain your maintaining your details, and in maintaining your details, there is a form which they call an RAV form, RAV form. So within that RAV form, it has got an option to register for taxes. Okay, so with that option for registering for taxes, then it will ask, are you exceeding 50,000? Then you say yes. And then do you want to register for a 1 month period? Then you say yes or no, or you opt 2 months. Then once you complete that form, and then you indicate, okay, currently for the past 12 months, or our current sales, we've done more than 500,000, to show that it's more than 50,000. Then the system can register the firm for VAT. And once the firm becomes a VAT vendor, they have to charge everyone. They have to charge every client fees. You cannot opt to say, oh, this is a friend, this is what. As long as the service is rendered, VAT has to be charged, okay, on the fees. So if a firm opts not to charge VAT, the commissioner would deem in that amount that you have charged VAT, and they will claim their VAT. Okay, so in instances where a firm has exceeded $1 million and the commissioner gets to pick it up, you know, they sometimes do compliance audits. So in them doing the compliance audit, they pick it up that the firm has exceeded $1 million. Then they also deem that in whatever, like if your fees are now 1.2 million, in that 1.2 million, they deem that there's VAT. So 15% of those sales, then it's money which is supposed to be paid to the practitioner, to the commission, to SARS. So what firms need to do, you should ensure that you check regularly if you are supposed to register for VAT. Okay, and then the rate, the VAT rate is currently 15%. It used to be 14%, and it was changed from the 1st of April 2014. So we are on 15%. VAT is a tax that is charged on what? Supply of goods or services. Supply of goods, any good, anything, clothes, bread, sugar, anything that you are supplying, as long as you are a vendor, you have to charge VAT. Services, any service, legal services, accounting services, plumbing services, electrical services, medical services, any service that one has to give to another person, VAT has to be charged, as long as you exceed that 1 million or you have voluntarily registered for VAT. Okay, and then the other terminologies that we do have, we have VAT periods. There's what they call VAT periods. So with these periods, it's period in which a firm or a practice or a company or a sole prop is given to submit its VAT. So the one that is given to farmers, it's a 6 months period. So every 6 months, they have to compute VAT and submit and pay, or if there's a refund, they receive their refund. Most companies, practices, and individuals, they opt for a 2 months period. So it's bi-monthly. So the bi-monthly, it can be odd months, it can be even months. So upon registration, there's a document that is given by SARS that they call a notice of registration. So on the notice of registration, they will stipulate to say your firm or your practice is supposed to submit its VAT, say for February, for April, for June. So it means if it's biannually, bi-monthly, sorry, if it's bi-monthly, then it would mean the one written February, you're submitting January and February together, and then you submit March and April together, May and June together, July and August together, just like that, continuously from two periods going. And in these submissions, you are given a month to submit. You are given a month to submit. If you do it manually, of which the branches, they no longer take manual submissions, because people used to go to the branch with their workings and then they are captured at the branch and then they're submitted. But now they just say do things electronically. So electronically means the use of what? E-filing. Okay. So for example, if it's a March and April return, then it has to be submitted by the 31st of May. You are given 30 days from the date, and your last day should fall on a working day. So say for instance, our Friday is on the 29th, and then our 30th is on a Saturday. So you are given up to the Friday. You cannot submit. So with SARS, they do not consider weekends as working days. If you are doing your submissions and you are within time, you can do any time, you can do any day. But when you are now at the end of the month and your end of the month falls on a weekend, they will not count those days. They don't consider them working days. So you will be penalized for submitting late. So you should always know that. Okay. And the other thing is that, so for individuals, we've got individuals who are running their own practices, and we've got advocates. They do not have companies, they run their own practices. So with those ones, they can register for VAT. Everyone has to register for VAT as long as 1 million is reached. They register for VAT. The concept is the same. Best option is to go on a 2 months period. And then the 1 month period, you find that one is for companies who are doing more than 20 million. So automatically the system will pick you up and then allocate you on a monthly basis. So it would mean the return for January, you submit it in February. The one for February, you submit it in March. The one for March, you submit it in April, just like that. Okay. And then the other terminology that we have, it's accounting, how we account for VAT. There are two ways of accounting for VAT. One is the invoice basis, two is the payment basis. I will start with the payment basis. Payment basis is only used by individuals. So your advocates, your sole props, as long as their annual turnover does not exceed 2.5 million rands. 2.5 million rands, then they can use the payment basis. They wait until they receive the money, then they account. Receive the money in their bank account, they account. Okay, and the invoice basis, companies, juristic, anything juristic has to use the invoice basis. Invoice basis, it says the moment you invoice, you have to include your invoice in your VAT computation. So your 2 months that you are given, April and March, you add up everything that you have invoiced, whether it was paid or not, you add up everything. And also when it comes to your suppliers, whatever that they've invoiced you over 2 months, then you add up and pay over. Remember, VAT, it's an invoice, kind of like a tax. You account for it using invoices. To prove VAT, you need invoices. They call them tax invoices. So your firm is supposed to issue invoices to its clients, tax invoices to its clients, as long as the firm is a vendor. And for it to claim VAT, it has to be issued with an invoice. So anything that you do not issue an invoice to anyone who is a vendor does not qualify for VAT. So things like salaries, they don't qualify for VAT. And then there are certain expenses, obviously, that the Act on its own will say, like for entertainment, you cannot claim VAT. For motor vehicles, passenger motor vehicles, you cannot claim VAT. Okay. All right, and then part of our terminology, we have the way that we compute. We've got what they call output VAT, input VAT. So output VAT, it's on our invoices that we are giving out to our clients. So when we take instructions and then we do the work, we issue an invoice. When we add up all those invoices or all those receipts, money received, it's called output. So it should form part of the top part. And then the bottom part, it's the input. So the input, it's all those invoices that are charged against the client, our firm. Okay, for our firm expenses. Okay, not like advocates. Advocates, they give us invoices on behalf of clients. So those are not firm invoices. Sheriffs, they charge on behalf of our clients. So we are just executing on behalf of clients. Those are not our invoices. They don't form part of our input. Because remember, on our output, it is just our fees. Our fees. Disbursements, we do not claim, like we don't charge VAT on disbursements. So it is on our fees. And then the input, it's on our fees. Okay. So say for instance, we've got a telephone system in our office, and then we are charged VAT. We can claim it against our VAT that we are supposed to pay, our output VAT. And also things like stationery, our airtime, and motor vehicle repairs, any computer repairs, computer purchases, all those things we can claim. But there are certain things that we cannot claim. Okay, I'm just going to finish on VAT, then we take a break. So things that we cannot claim, like I mentioned before, it's our entertainment. This includes staff teas, it includes refreshments, boardroom lunches, client entertainment of all kinds, we cannot claim. So if we buy things like our microwave, the office microwave, whether for clients or for the kettle, we cannot claim VAT on those. They are rejected by SARS. Okay, so if ever SARS conducts an audit over our return, and then they say, give us a schedule that shows what you claimed against what you were supposed to pay, then they see that there are those expenses, they will take them off. So if you've got your McDonald's, your Nando's, your KFC, know that you are charged VAT, but you cannot claim it because there's no production of income there. So they don't consider it production. They say you are entertaining. So you are not, like, there's no production. So I think it's SARS limiting abuse, because those are the expenses that most firms have, unlike, manufacturing entities. And then the other thing, like your motor cars, motor vehicles, for carrying passengers, there is no VAT that we can claim. This will include our normal passenger vehicle, which can carry 5 people, our combis, our double cabs. We cannot claim VAT. Unfortunately, we can't. But if it's a bakkie, like for construction businesses, a bakkie, they allow trucks, the heavy trucks, they do allow for one to claim VAT. And then salaries and wages, there is no VAT. Your employee is not going to charge you any VAT. They are not going to give you any invoice. So there's no VAT that we claim there. And then any expenses paid on behalf of the owner or partners or directors, like your school fees, your groceries, you cannot claim VAT on that. Okay. So VAT may only be claimed on business expenses only. Okay. And also with VAT, then one has to look at accommodation. You should read on that. When can one claim? And membership fees, when can one claim? And the other thing that I wanted to mention, let's see, about VAT. So at the end of the day, then we have the net, which is what, when we say output minus input, then we come up with VAT payable or VAT refund. Wherever we are having a refund, we submit. We have to submit no matter what. Whether it's a zero return, we haven't traded, we haven't done anything, we have to submit. And then after submission, then SARS will either ask for documents or they will just refund. Or if it's our turn to pay, then we make sure we get our references and then we pay SARS. Okay, and then part of the terminology that I had left out were to do with the rates, VAT rates. So we've got zero rated goods. So say for instance, if you're buying your goods, but anyways, most of them which are zero rated are groceries, and already groceries are what are exempt. And also if you look at fuel, motor vehicle fuel, diesel and petrol, they are zero rated. So there's no VAT to claim because you were not charged VAT. Okay, there's no VAT to claim. So you cannot claim VAT on motor vehicle, fuel and diesel. But on repairs and maintenance, yes, usually we are charged, then we do claim. So you have to analyze your invoices because the invoices are the ones that will tell you whether you were charged VAT or not. Okay, and also you should always know that there are certain suppliers who are not VAT vendors. They are not registered for VAT. If they haven't charged you VAT, you can't claim VAT. No, we were not charged, no claiming. And then we've got exempt goods and supplies. Exempt goods, we've got things like your education, your transport. So passenger transport, it's exempt from VAT. So which means if you are in your Uber, you should check their invoices. Probably they charge on service fee, admin fee, but when it comes to the cost of carrying you, there's no VAT that is charged. Then it's exempt. In your case, when you're doing your return, your schedule, you then do not claim any VAT from exempt. So most people, they work from bank statements. So when they're working from bank statements, they don't have the actual invoice. They don't know these things. But once you attend classes like these ones, then you know, because we are teaching each other, we are telling each other what the act says. So you should know what the act says so that when you get audited, you are aware of your contraventions, or you are aware of things that you are not supposed to have done. Okay, that is VAT. So I'm not sure if anyone has got any question on VAT. Any questions? Okay. So let's say there is no question. Let's then take a break. It's 5:10. Let's take a break for 10 minutes. We come back at 5:20. It's 5:09. We come at 5:10. And then we do an example. We do an example, and then that example, wherever we finish it off, then we'll continue with it next week, just for me to help you with your assignment too. Okay, thank you very much for listening, for your patience. Welcome back. Welcome back to our webinar. We'll continue and our webinar is still being recorded. Okay, I have one chat. I think it's Happy, where it is his or her hand raised, and also she said please provide the accounts example. So Happy, I'm not sure if you mean after we are done, then I should provide the example of which, yeah, I will do that. I will post it on the platform. If you mean that, I'll post it on the platform so that you guys are able to proceed and practice. Yes, so okay, let's continue because I'm not getting any feedback from Happy. Now we are going to go through a question and then we are going to more of like answer it in Excel. So what I'm going to share in our question. Let me share the screen. Okay. So this is hello, hi Happy. Are you still raising your hand or let me remove it? Okay, so let's proceed. This is the question that we are going to attend to. I hope you can see it clearly from your end, and I hope you can hear me and I'm audible enough. Okay. And then it says our firm is a VAT vendor and handles the following transactions for the month of June 2022. Okay. So since June, nothing has like more of like changed in the VAT Act or in any of our acts. Nothing much has changed except I think that checks were abolished. So those are the things that we do not cover anymore. Okay, and then it says record the following transactions in all necessary cash books and ledgers. Remember, cash books are more of like our source documents. They carry one leg of the transaction, and then our ledgers are the ones that carry the second leg of the transaction. So when we have our cash books and our ledgers, then we more of like have a complete set of transactions. We'll have our debits and credits, and we'll be able to balance them with the trial balance. Consider these transactions to be for one firm. So if we say they are for one firm, it means you have to account all the transactions in one set of books. You do not separate, you do not create several cash books if we have one account. You only create a cash book for each account, If it's a trust account, one cash book. If it's a business account, one business cash book. You do not have to create separate ones. Balance off the accounts and prepare the trial balance for the business transactions and a trial balance for the trust transactions as at 30 June 2022. Okay, so we have the trust account with the given transactions. And then those are the general transactions. And then we've got the business account with the given general transactions. And then what we do then, we get into the conveyancing. We then handled a conveyancing matter, or let's say this particular firm handled a conveyancing matter. So a conveyancing matter will more of like touch on trusts as well as business, because on the business side, then there's a transfer of fees. And then we've got a collection matter. Okay, and yeah, so we've got two matters. So what we'll attempt to do is that let's for today, let's record for the 30 minutes that we are given. Let's record our trust account with the general transactions, and then when we come next week, we do the conveyancing and collection matter for the 2 hours that we are given. Then once we finish, then we are finished with our webinars. Okay. So for us to answer these questions, I am going to create our ledgers and cash books in Excel. It's like that. So what I've done our T account. So this is our trust cash book. And then we indicate on top the firm name, the firm's name. Okay, so you have your T account, which is demarcated by the board line. Okay, and I'm going to share with our question. Hopefully you are able to see the question. And I'll minimize the question so that we can read it. Okay, so from the question, it says the trust account is an opening balance of 208,000. I hope you are able to see the Excel and the PDF together, the screen that I'm sharing. Okay, and the 208,000 is made up of 100,000 from Mr. Jaden and 108,000 from Miss Magda. So that's the money that we are holding in our trust account. So this is the 1st of June, and then this is our trust cash book. And our firm, okay, our firm was not given a name. All right. So we start with our date, 2018, 2022. Like that, 1 June 2022. So we've got our opening balance. So with the opening balance, you find there's no need for you to split it. To split it between our clients, because what if you have a trust account which is sitting with 100 clients? Are you going to do a split of those 100 to show? Because remember, they are in our ledgers. When we are continuing with our ledgers, we just continue with the balances, and we know we've done a reconciliation from the previous period, and we know that this money is for 1, 2, 3, 4, 5 people. So we do not have to do a split again. Okay, and then so our opening balance, we also are supposed to then do the double entry for our opening balance. So what I'm going to do, I'm just going to copy the format. I just need the format, and then create what we call our trust ledgers. Okay. So like that. So these are our trust ledgers, so that we do our double entry, just like what we did previously, what I showed you previously. So we are just more of like continuing with that. So with our ledgers, this is the ledger. So it has got a debit side, it has got a credit side. So we don't call them receipts and payments, because in our ledgers, we are not receiving, we are not paying. We can be accounting for something different, and where we are not even receiving or paying. We can be accounting for transactions where we did not exchange money, like your depreciation. So we should know what is it that we are debiting, what is it that we are crediting. Okay. All right. And then so with our first ledger, we are doing it for our trust ledger. We are going to do it for Mr. Jaden. So it's a Mr. Jaden. So with Mr. Jaden, remember our trust cash book, we've started with a debit. So we've done a debit, our opening, it's a debit. So which means to counter that, we are going to do a credit between Mr. Jaden and Miss Magda. So our date is on the 1st of June, 2022. And then this is our opening balance. How much is our opening balance? 100,000 for Mr. Jaden. And then this is more of like our ledger account for Mr. Jaden. And then we then need to do one for Miss Magda for the opening balances. So here we come. I hope this is big enough for you to see. Try to enlarge it a bit. Okay, so Miss Magda. So it's the 1st of June, it's the opening balance, and we are told that it's 108,000. Okay, this is how we account for the opening balances. And then we move on with the trust. And then we are told that we attended to the file of Mr. Jaden and raised an invoice on 15 June 2022 of 22,000, including VAT. Okay, we transferred our fees on 29 June 2022. Okay, so we have raised an invoice. Okay, so when we are raising an invoice, this is more of like a business transaction. A business transaction because we are raising an invoice. So it's on the business side of things. So the business side of things, we have the business cash book. So I'm just going to copy the template so that we have a template of the business cash book. Okay, I'm going to copy. I'm just going to try to attend to with no sequence of dates. So forgive me for the sequence of dates. I'm attending to business cash book as we are told. I'm attending as we are told. Okay, and then with the business cash book, we also are supposed to have so the matters. So we've got trust creditors, and then we've got business credit, business debtors or matters. Our meta ledgers. So meta ledgers, it's for matters that we are handling. Okay, so in normal business terms, we call it a business, our debtors ledger. Let's call it our debtors ledger or matters ledger. Okay, so the structure of our T account, it's still the same with a debit and a credit. So I'm just copying the format here. So that's what you also need to do. You just copy the format, you paste it. So these are our business debtors. Or meta ledgers, like that, for the business side, like that. Okay, and then the other set of ledgers that we are supposed to have, we've got the business cash, the debtors, and usually we have creditors, and we have the general ledger. Okay, general ledger on the business side. So the general ledger is the one that we account for income, expenses, assets, and liabilities, which are general. Otherwise, our creditors are dealt with in a creditors ledger. Okay, so this one is a general ledger. Okay, so this is our general ledger. This is where we record our fees. So what I'm going to do is that I'm also going to create a worksheet where we do our workings. So this is for our workings. So we are given that we raised an invoice on 15 June. So if we raise an invoice, our date is 15 June. So I want to show you which account are we going to debit. So which account are we going to credit? So to debit, and then to credit, and then the amount. Okay? So in this case, we raised an invoice and it's 15 June. Okay, so it's raising an invoice. So the account that we are going to debit, it's going to be our data, our data, which is Mr. Jaden. We are raising an invoice for him. Remember, assets do have debit balances. Assets, it's something that belong to the client. So once we have done work for Mr. Jaden, he becomes whatever that he owes us for the work that we have done. It's more of like an asset to the firm. You see, so we are debiting Mr. Jaden. And how much are we debiting? We are debiting him with 25,000, inclusive of what? Of VAT. As our data, he's owing the firm inclusive of VAT. So this is our fees plus VAT. That's what we debit our client because he's owing us the full amount. And then to credit, we are going to credit the fee account. If it's fees account or fee account like that. And we are going to credit the VAT account. So this is the journal entry that we record. This is how we record the debit and the credits. Okay, so here let me also say debit, and then here I say credit so that we distinguish them. Okay, so the account that we are going to credit, sorry, here it's like that. We are crediting the VAT account and the fees account. And how much are we crediting to the fees account? We are told that we are invoicing 25,000, including VAT. So it's going to be, we want to separate now, 25,000 multiplied by 100 divided by 115. So 115, it's our fee plus VAT. Our fee is the 100% plus VAT. So it forms 115. So to derive our fee, it's 100 divided by 115, like that. So this is our fee from the 25,000. And then the VAT, it's 15%. It's 25,000 multiplied by 15 divided by 115. So it's because the 25,000 is our amount plus 15. So it's 100 of us plus 15. We are adding SARS on top. Okay, so it's when we calculate the VAT, we are now taking the VAT out of the 115, the 25. Hence, the formula is like that. Amount times 100 divided by 115, and then amount times 15 divided by 115. So if we can add up these two, if we can add up, you will be able to see that then they give us 25,000, 25,000. So we are adding up, you see, and then we are now balancing. If you look at it, then our journal entry, we balance. Control be like that. We are now balancing. So this is how we compute, we calculate our amounts. So the account to debit, it's the data, which is Mr. Jaden. We are debiting with the VAT, the full amount, which is fees plus VAT. So when we go to our data's ledger, this is our data's ledger. We've got Mr. Jaden, and we said we are debiting him. So it's 15 June 2022, and it's our fees plus VAT, like that. How much is it? 25,000. You see, that's how we record. We've recorded this. Now we do the double entry. We go to our general ledger. So on our general ledger, we then have our fee account. So this is our fee account. With our fee account, it's 15 June 2023, 2022. And it's against Mr. Jaden. How much is it? 25 multiplied by 100 divided by 115. So that is our formula. That is our fee. And then we have recorded it in the fee account. But we are not yet finished because we won't balance if we are like that. Then we also record the VAT that is due to SARS. So we record our VAT account. And it's coming still from the fees of Mr. Jaden, and it's 15 divided by 115. So this is how we record. On top, it's our fee account. Underneath, it's our VAT account. Okay, so that's transaction A for us. And then transaction B, we briefed Advocate Makiba on the matter of Miss Magda, and he rendered, oh, sorry, for that, for transaction A, we transferred our fees on 29 June 2022. So for transfer of our fee, so when we are transferring our fees, so this is 29 June 2022. Okay, so we are moving money from the trust account to the business account, from the trust ledger to the business ledger. Okay, so there are 4 elements, 4 transactions that should occur. So it is called a trust transfer, usually a trust transfer journal, because then it shows those 4 transactions. Okay, so on the debit, what we start with, it means we are going to pay out of the trust account. We are going to pay out of the trust account. So the account that we are going to credit, definitely it is our trust account. Ne? So on the trust side, so the one that we would debit, it's Mr. Jaden's account. So this is our trust transfer journal. Trust transfer journal. Journal or journal, yeah, like that. So Mr. Jaden's account trust ledger, we're going to debit it with how much? 25,000. Let's call it T, like that. And then we are going to credit the trust bank account, trust bank or trust cash book with how much? 25,000. Okay, so this is the first part of our transaction. This is the first part of our transaction. This is how we are going to work on it. Okay, so we also go to our ledgers. Let's start with the trust cash book. On the 29th, so we are told that on the 29th of June, we are paying out to the trust into the business account. So we are paying it's from Mr. Jaden's account, and how much? 25,000, like that. So this is our trust account. We say trust account, receipt side, payment side. We are paying out, we've credited. And then also in the trust ledger, then we debit. How much? 29 June 2022. It's trust bank. You see, we are moving fees here. How much? 25,000, like that. So the double entry is finished, but we haven't finished our transfer journal because this money is supposed to then go to the business account. So to the business account, the business account is receiving. So business bank, how much is it receiving? 25,000. And then we are crediting, which means Mr. Jaden has paid. His account is going to be credited, written off, like he's not going to be owing us the 25,000 anymore. Then we credit him to release him from the debt that he has against the parties. So it's Mr. Jaden B. So in bracket we B business account. It's a business matter ledger. We debit. So if we go to our business cash book from our workings, then we know. Remember, I told you, don't worry about sequence. So it's from Jaden, Mr. Jaden, like that. And it's a trust transfer, 25,000. So also it's nicer for you to even give more details so that you are able to track the transactions. So we have received, and then when we go to our data, so on 29 June 2022, it's a receipt, a business account, and also it's a trust transfer, like that. We give it more information for the sake of just us knowing that it came from the trust account. So business account, or it can be bank account referring to the business, because this is the business side of things. Okay, so that's how we account for part A. I hope you have followed it through. So this is the initial part where we raise our invoice. And then after raising our invoice, then we do our trust transfer. So it's raising of invoice. And then part B, which is given, because the sentence goes to part B, which is the trust transfer. And then this is how we do our trust transfer. Okay. And I hope it's clear. And you can follow through. Okay, and then part B, we brief Advocate Makiba on the matter of Miss Magda, and he rendered us a bill of 7.5, which we paid on 24 June. Remember, we've got money in the trust account for Miss Magda, and money in the trust account, remember, when do we withdraw it? To or on behalf of the client. So it can be that we are paying the client for settlement. If we're dealing with a matter where we are supposed to settle a client, it can be our seller, we collect money for him, we pay him. Or it can be that we appoint an advocate, we appoint a sheriff, we appoint a tracer, if we've got money in the trust account, we then can pay any consultant, we can pay anyone on behalf of the client, as long as we have informed the client that this is what we are doing. Because remember, we consult with our client, we talk with our client, and then from there we proceed and we implement. Okay, so 24 June 2022. So we are paying. It's a payment, and it's a trust account. So the trust is going to be credited. So our trust account is going to be credited how much? 7,500. And we are going to debit our client, Miss Magda, the trust account, like that. And it's a credit. Sorry, we are debiting. So the trust is a credit, like that. It's a payment. And Miss Magda, it's a debit, like that. Ledger account, like that. Okay, so we go, let's pay. And it's on 24 June 2022. We are paying out of trust. So it's Miss Magda. That's the file that we are paying from, and we are paying to Advocate Makiba, like that, or Majiba or Magiba, like that. We are paying out, and then when you go to our trust ledger, we go to our trust ledger, 24 June, and it's from the bank account Trust Bank, and it's Advocate Makiba. So Advocate is never our client. He's not our client. We do not open an account for him because he's not our client. This is between us and our clients and what we do on behalf of our clients. So there is no account that we open for the Advocate. Okay. And then 30 June 2022, we've got bank charges. Bank charges were 98. Interest was 405. The bank will transfer. We will make a transfer to the LPC on 1 July. Okay, so we are doing the transactions for what? For our transactions are for June. Okay, so 30 June 2022, we've got interest like that. How much interest? 405. So with the interest, you can see interest is more than bank charges. So our trust ledger that we are going to create would be for the fund. Remember, we said net is payable to the fund. Payable to the fund. So the fund becomes our creditor in that legal practice fidelity fund, LPFF, becomes our creditor. In that we have received interest on their behalf in the trust account. So 30 June 2022, it's a trust bank and its interest. How much? 405. Like that. Okay. So we've recorded the trust interest, and then we go back, we pay out, and then the bank debit its bank charges. That it's paid out automatically, 98. And then when we come to our trust ledger, it's 30 June 2022, and it's bank charges like that. How much? 98, like that. Okay, so this is how we account for these trust transactions. And the business side, okay, the business side, we are given opening balances. 1 June 2022, we've got opening balances. So we'll just do the opening balances. I think our time will be up. And then next we'll continue with the business and also do the 2 transactions that we conducted in the month of June. So we are told on 1 June 2022, we had an opening balance, the cash book balance of 20,500. So we go to our business. Now this is the business side. Okay, it's our opening. So I'll move this transaction slightly down. Let me move it slightly, let's say here, 29 June 2022, Mr. Jaden. Trust transfer. I just want to move this transaction so that we show the opening balance where it's supposed to be. And then we delete here. So on 1 June 2022, we've got our opening balance. So our opening balance is 20,500, like that. Okay, and then we are told that the opening balance is made up of what? The capital amount, 70,500, furniture account, 15,000, office equipment account, 25,000, motor vehicle account, 95,000, MFC bank loan account, 85,000. So when we go to our general ledger, so this is all business, this is all general. Then we create these accounts. So I'm going to create them on top of everything else. Like you put in space, and then I copy the T account from the fee, just so that we don't spend most of the time. Just gonna copy this. I come here, I paste. Then I start with the capital account. So the bank, a capital account is always having a credit balance, unless if it is stipulated that it has got a debit balance. 1 June 2022, So it's our opening balance of 70,500. Okay, so that is the capital account. We record the next general account, which is okay, let's do the MFC loan so that the credit balances can be on top. Opening balance, MFC bank loan. Like that, opening balance, 85, like that. And we do the next one, which are now our assets, our furniture account. And with our furniture account, it's an asset. An asset should have a debit balance. So on 1 June 2022, that's our opening balance. How much? 15,000. Just like that. Okay, and then we do the next one, which is the office equipment. So these are general business general ledger accounts. These are just what office equipment account. And then office equipment, we are told that it has got an opening of 25,000. And then the last one being the motor vehicle. So I'll create more space just for the motor vehicle. Okay. Motor vehicle account. With the motor vehicle account, the opening balance is 95,000. Okay. So these are our opening balances of our general ledger accounts. Capital account, credit balance, MFC bank loan. So our loan is the one that more of like financed our car. Then we are left with what? 85,000. The furniture, the firm bought furniture in periods like periods before this one that we are doing. And then we bought office equipment. We also the car that we spoke about. And then the fee is coming from the trust account. Okay. And on 1 June, the following debit orders are paid. So what we'll do is that part B, we'll work on it when we come back next week, Thursday, and then we'll finish off Thursday. We also look at the conveyancing matter and the collection matter. So what I will do today is that I'm going to share the question. I'm going to share in the working papers, these working papers that we have, so that you can go and we attempt the question, what is left, part B of the business account, the collection. And then when we come back and work together, if you have got any questions, then you'll be able to ask any questions. Okay. I hope you were able to see our workings. I'm going to save them. And I'm going to put them as an announcement, which will be delivered to you. And then you can proceed and complete. And then this will help you with your question, with your assignment. I know I'm giving you work, but it is work which is good for you. Work which is good for you. Let's see. Okay, webinars. So it's 2023 webinar. So it's webinar 2 answer 2310.12. Okay, so webinar 2 answer. Okay, let me unshare. Do you have any questions? I'll check on the chat. We don't have any questions. We don't have any issues. I think we are more of like done. I'm going to share with you our we answer and also our questions so that you yeah, you can work on it, and then together we continue next week. So if there are no questions, there are no issues, we can call it a day, and I'll stop recording. It's a minute past 6. Happy, do you still have a question? Anyone with a question? Can you hear me? Is anyone there? Is everyone there? Are you there, guys?
Yes, we are there.
Yes, we are still here.
Yeah, still there. Okay, thank you very much. So I hope this was beneficial, and it will help you further with your studies as well as your assignments. Let's meet again next week, and I'm going to share this with you, and yeah, let's take it from there. I'll stop recording because I don't think we've got any questions.
Thank you. Bye.
Bye-bye.